Hello and welcome to another exciting episode of Finance Footnotes. I'm Brent Stransky, your host, joined by my friend and colleague, Zach Miner. Today, we're going to talk about all the comings and goings in the marketplace. I'm purposely avoiding the topic of the election for the most part, but I want to take a litmus test of where we are in the markets. I want to highlight a couple of the risks I see on the horizon, but then end on a couple optimistic points, which tends to be my usual arc for these type of conversations. But before we do, I want to ask you, Zach, do you see anything exciting and updated here on our first slide?
Yeah. I mean, I was clicking through some of your slides here, and I think we might have a little bit of disagreement today, which I like.
But just by way of background here, I think one of the great things about this particular podcast is that I have an advanced degree. I have a CFP. The CFP, I think, is the number two most difficult designation in this business. And Zach has the number one, the CFA, Chartered Financial Analyst, and then the CFP now as of last week. So
Thank
congratulations,
you.
my friend.
Thank you.
Very exciting times here, especially for you folks at home. Just giving more prominence here to your two friendly hosts. So that being said, compliments aside, let's move forward here. It's 2 weeks past the election. And I feel like the markets are still trying to find its footing here. Per usual, I have the clipping from the Wall Street Journal this morning, which I read digitally, but in paper form. Try to spit that out and explain it to folks. But it comes as a PDF in the traditional. That's the way I like to digest my journal. But here we're looking at just a clipping here. Markets are near all-time highs, and today seems to be a pretty good day here, digesting some positive economic news. So things did shoot up after the election, took a big breather last week, big step back towards where we started, ironically, and now
Right.
seem to be ticking a little higher. Pretty funny, pretty crazy times.
Yeah, definitely. I mean, Nvidia reported their earnings here yesterday. After the market closed, the largest company on the planet reporting 100% revenue growth, which is just absurd. Typically, the companies that large, if you get double digits, you're in a great place.
It's so
Um,
it's it, and to put you on the spot here. So funny. So they blow out earnings, but not what the market expect. I'm looking as of this second. Nvidia down 1%. What
Honestly, I think that's
started to
probably,
change?
yeah, I wouldn't even say that's a indication of how good the quarter was because it was pretty good by all metrics.
Hmm.
But the stock's up 200+% on the year. So, whenever you get an opportunity to do some profit taking, that's kind of what you're going to see there.
The
So,
point I was making, though,
yeah.
just a slide. So the big news is Nvidia, which is that, as Zach just said, the biggest company in the world, I think,
Yep.
at least public traded here in the U.S. indexes. And then, uh, just looking, I think the Dow Jones has 30 blue chip stocks. They kicked out one and added Nvidia. Was that immediate, Zach, or does that take place? Do you know if that already happened?
Oh, that's a good question. I think it did happen. I think it was earlier this month, but I could actually be wrong about that. That's a good question.
And I'm just looking here in CNBC, and I don't know. Oh no, it is. Yeah, according to CNBC, it's on the index, and it's interesting
It is
because
in
here
there.
it
Okay.
is. And this, of course, as you know, is what do you call this? It's not a cap weighted, a
Price
stock
weighted.
weighted, price weighted. Blah.
It is
Uh,
price weighted, which is a very strange way to weight an index. It's based off the price of the actual stock, which is
mhm.
really why the Dow is not a great index to look at. It's the original, right? I think that's why it's just persisted this long. It's the one that kind of started it all with regard to indexes, but it's only 30 companies and it's price weighted. And the price of a stock doesn't really mean all that much because there's stock splits, there's companies that choose to do it, choose not to do it. The price of a stock doesn't necessarily indicate much about its intrinsic value, right? It's per
And that's
share
exactly my
value.
point. So here we have NVIDIA, which is the largest company. So if you look at the S&P 500, it must be the largest, which is a capitalization weighted index. That's why people talk about concentration risk. The top seven account for something like a third of the overall market cap or more.
Yeah. I think it's
But
close to 40% now.
that's
Top
crazy. So
10. Yeah.
the one positive about a Dow price weighting is that you kind of avoid that concentration risk in some models,
Sure.
but it's just a monkey in a dartboard, as it were. Um, the third option would be like an equal weighted index, which you can find out there in the universe, which we can talk about at a later point. But the point I'm making here is the Dow Jones market index is up significantly today. Not significantly, it's 350 points, but the Nvidia is down. So there you go. That's just a little bit of a litmus test of where we are today, folks. I'm sorry to take a little bit longer on that, but I think that's a really good point. If you can, at a cocktail party, distinguish between capital weighting, price weighting, and equal weighting, you get a free drink at the bar. So moving right along here, one other place we'd like to dip in here is the CNN Fear Greed Index. This is something that you can access for free. It's updated daily, and they look at seven major and quite smart, indicators of market energy, I guess. People super optimistic, or are they extremely fearful? And of course, this is an inverse relationship. If people are extremely fearful, typically it's a good time to invest, and vice versa. But I thought this is interesting. If you look back a year ago, we were kind of in the greed camp about 61. About a month ago, just before the election, at 74, quite frothy. And here we are. I don't think people really know what to make of all the news coming out in the moment, Zach. Is that I was kind of surprised with this. I thought people would be kind of more in the extremely greedy camp. What do you think?
Yeah, I wouldn't necessarily think extreme greed, but I was surprised to see it kind of in neutral. But if you look, I mean, if you look at the market activity over the last, 2 weeks since the election, it's really just been a round trip, and we're kind of right back to where it was before. And I think there was definitely a bunch of kind of front running throughout the year, pricing in of certain things. And now we're just in the digestion phase where there was a lot of initial kind of optimism about the prospect for deregulation and lower taxes and all things of that nature. But now we're going to be getting into the more practical of, okay, what exactly is going to be done, what exact policies, who are the people that are going to be in charge of these agencies. So I think there's just some gyrations and some
Trepidations
digestion.
and gyrations. Yeah.
Yep, digestion and gyrations is the
And
period of
trepidation.
where
I
we're at
like
right now.
it. I like the SAT words we're pulling out this
There
morning.
we go.
So, I think it's a good litmus test. Listen, there's a lot of different variables that need to be used in your market decisions here and your investing decisions, but I like this one, and it breaks down 7 key indicators. And one of them I have highlighted here on the screen is the put call ratio. I think this is particularly a good option. This is when folks are buying insurance or buying leverage on their investments, and you can see that the more puts is when you're buying protection. Typically, in the options market, these are derivatives, a dangerous word here in finance. But you can see here in this particular chart, which goes back a year, that there have been at least three peaks, and we're not really near a peak. So while this index flashes fear, according to the CNN, I was kind of surprised that it does seem typically low. It's just higher than it was. So
Yeah,
it's bounced from a month ago,
neutral,
but
neutral
um,
positioning. It's kind of where we're
yeah,
at, right?
I really think so. So just a quick litmus test of where we are, friends listening and watching at home here. I wanted to share just a few important charts here, kind of where things can go going forward. And we've talked about this chart before, Zach and folks at home. This is market sentiment. This is a panic euphoria model. I believe this is from Citigroup. This is one I've watched. It comes from Barron's. They publish it twice a month. But it's really interesting because you can see here we are in that blue phase. I have a green highlight here showing you that we are in the euphoria phase. And if we kind of look here and just read the bottom, what it's saying is that when we're in that phase, they predict historically an 80% probability that stocks will be lower 1 year later. So interesting that they're measuring a lot of optimism. So this is kind of contradictory. This is 2 weeks old, by the way. And the CNN data is from yesterday. So, I don't know if it changed that much in 2 weeks. Typically, this is a slow lag on this particular sentiment indicator, but I think it's reason for pause. This has been typically a good thing to watch going forward. So, I just want to highlight that here for us, folks. It has my ear perked up a little bit. Things might be a little frothy as we go forward.
Yeah, we'd have to fall a pretty good bit though to get to when it first ticked into euphoria back in March. Um, we'd have to probably fall 15% at least to get to a net kind of a negative number year over year from March, right?
Yeah,
If that's kind of what it says.
let's make a note here to follow up with ourselves and see if this is actually an indicator that worked. And
Yeah.
listen, we talked about this a couple weeks ago about how price to earnings index and 2 years ago the Bloomberg economic modeling forecaster predicted with 100% accuracy that there's going to be a recession in 2023, which of course did not materialize. So listen, things are prone to failure and prone to risk. But just a point that I wanted to make here, which leads into something, Zach, we've talked about before. Listen, price to earnings, that's how we measure, market valuation, the most common metric. And you have a couple others listed here. This is from JP Morgan at the end of the month. And you can see here that we are nearing the highs that were put in pre-tech crisis. Okay. So I think things are a little frothy here. We're a full standard deviation above normal in terms of that pricing there. Zach, we've talked about this before, but I want to go to one more chart there, which is kind of from the same stack deck or chart deck from JP Morgan. And Zach, I know you've pointed this out before, but I just wanted to highlight it for folks because I want to bring on 2 new indicators here, or just market points that I want to highlight. And what we're seeing here is a wide dispersion. This is looking at what can we expect if market valuations, and this is going back, I believe, to the 1950s. you can see that over a 1 year period, it doesn't necessarily matter what's going to happen. There's a wide dispersion, and that's that chart on the left. But the chart on the right, you're seeing coalescence or conversion to the mean. And you're seeing here that with a price to earnings ratio of 21, 1.5 standard deviations above normal, we can see that on a 5 year basis, on average, the expectation is hardly anything. And I have it highlighted in green, and there's a kind of a red dot going there to the axis. And you can see that, if history is any indication, which is always, we have to say with a grain of salt, things might be a little bit more choppy going forward into the next 5 years, Zach. This is something that you've highlighted before. I just wanted to float it back to the mind share that folks are seeing out there. What do you think?
So I love looking at price to earnings because I think it is not quite as valuable as folks may think.
Oh no, I see an
I know we're
I
doing
see
it.
you popped a chart in here.
We're doing an
Oh.
intra pop. We're doing an intraday prop. I think that the nature of, and we talked about kind of the nature of the market has significantly changed over time. But one of the ways in which it's changed is that for the S&P 500 in particular is kind of what we're talking about. That's the P ratio of the S&P 500. Those companies have just gotten so much better at doing what they do. And I put in here the S&P 500 operating profit margins going back to the year 2000, which interestingly coincides kind of closely with your that first valuation chart, right? That goes back to 94. So kind of similar type timeframes. But if I'm comparing the multiple that I'm earning on a stock today in 2024 versus the multiple that I was earning on the stock back in the year 2000, well, I'm not really comparing apples to apples because I'm comparing a stock that has a 12.1% average operating profit margin with something that had a 5% profit margin. So naturally, every marginal dollar of revenue that company now generates is generating more in earnings, which I should naturally pay a higher multiple to purchase. And so if you're just looking at it on, hey, we're at 21 point whatever percent, and that's compared to what it was in the year 2000, and man, it looks frothy. I think that doesn't necessarily do justice to the underlying companies in the actual index.
Let
So
me
I
just
always like
play
to look
the
at this.
let me just play the fool here, which isn't much of a stretch. Just kidding. Folks pay me for my brain power here, and let's not diminish that value, Zach. Come on. But does this really change the denominator in the price to earnings, right? The price is just the value of the stock, right? The total capitalization and the earnings,
Yep.
right? So, if the earnings are X and we're multiplying it by, 4.9 or 12.1, that's the profit margin. I agree with you. It's nice the companies are more efficiently run and have a higher profit margin. But that being the case, that wouldn't change necessarily the dollar value of the denominator. Am I missing something?
It doesn't change the current dollar value of the denominator, but it does change every marginal dollar of revenue that you bring in. So that every next dollar of revenue, instead of generating 5 cents worth of net profit, which falls to that denominator, now it's 12 cents. And so you're factoring in that looking forward, especially on a forward price to earnings ratio, that the earnings that it's going to generate, the revenue growth that it's going to generate is going to create more per each marginal dollar of earnings. Does that kind of make a little more sense?
And I think your point is well taken that price to earnings isn't always a great indicator going forward. And I think that's the point of the previous chart, which is there's wide dispersion over a 1 or 2 year period, right? But maybe there could be some coalescence
And look,
over a
that,
5 year or
I
longer.
don't want to like totally throw out the P ratio, and I definitely don't want to throw out that second panel of your chart where the 5 year forward P ratio does tend to have a good predictive power of forward returns. And I don't want to say that we're not in a situation where it's cheap, right? I'm not saying that at all. I just do think that when you're looking at some of this stuff and saying like, folks, and I see it all the time online. We're like, oh, we're nearing tech bubble valuations. I was like, just hold on a second. I don't know if we're necessarily at that point. Not saying it's cheap, and I'm not saying that it doesn't have any predictive power. I do just think that the nature of the companies are just so much more efficient. They're run so much better, and every dollar of revenue that brings in, more of it falls to shareholders
I like it.
relative to the
I
past.
like it.
So that's the kind of the point that I wanted to make there.
Point well received, sir. This is why we're paying you the big bucks here at Finance Footnote. So I'm going to spend a few more slides. I'm going to start by giving you two more data points here on folks. Clients are asking me about this, right? And I'm sharing this information with clients, right? PE ratios are one thing, and then I'm going to share a couple of places that we might consider going with our money if we reallocate, and end on two positive notes. So thank you for bearing with me here, folks. But the first is, and I know you saw this in Zach, but Warren Buffett, as of end of last month, he disclosed his quarterly holdings has his biggest cash position ever. He doubled his cash position this year, which of course a lot of astute market followers point out that he missed a huge run up with a third of his cash. But if this soothsayer, this very successful investor, is kind of moving to cash, it's kind of a startling thought, unless he's trying to buy something huge. Zach, do you make anything of this? Or you just kind of whatever, it doesn't matter.
So again, you have to kind of put it in the context where he's earning, and Buffett has said this multiple times in his annual meetings where he kind of gets up there and gives a window into his thoughts where he can earn 4.25% cat risk free, right, in
Hmm.
treasuries. And so he's not sitting in cash like at the bank, right? He's buying treasuries. And so I think from his perspective, he's looking at the landscape of how Berkshire invests, which is really on a longer term basis. Like they build positions in companies that they want to eventually own a significant portion of, and he views that the return on capital is not particularly attractive. I think it would probably be different if he couldn't earn 4.25 in treasuries, right? I
That's
don't
fair.
know, like I don't know if he would be sitting in that much cash. Where, so if you look at the overall trend going back to like 2000 of his percentage of cash holdings in Berkshire, um, it reached similar levels back in the early 2000s. So you can see, I think June of 2005, it was right around where it is now, about 30-ish percent. But then for most of the 2010s, it was very low because it just wasn't, there was nowhere else to put it, right? It wasn't earning
Hmm.
anything. So
So that
I
it's
think it does, yeah, I think it does say something. I just don't know, not sure exactly what to make of it, whether or not that's an indicator of,
from a guy who's from a genius. I don't know. From a guy whose
yeah,
famous quote is, the ideal holding period is forever. I think it's something that would kind of put our ear up a little bit
for
here.
sure. Definitely.
This is an article last week in Barron's is kind of highlighting this fact. And of course, it was all over the finance news space, as anything that Warren Buffett does gets picked up broadly. But I thought this is interesting, Zach. Do you happen to know what the premium is, the price to book ratio, or the valuation of Berkshire is above the actual net asset holdings? It's This is
Don't
essentially
know.
the fee, folks, that and I'll just save you the pain, Zach. The total valuation is 1.6
Okay.
trillion. Is that right? 1.6 billion. How much is he managing? I think a billion. The net asset value is one, let's say hypothetically in this its equation, and the value of capitalization of Berkshire Hathaway is 1.6. So essentially, folks are paying a 60% premium to be able to invest alongside Warren Buffett, which is in a world where we're talking about fee conscious investors. It just seems crazy to me. What do you think? I mean, just I saw that, I almost fell out of my chair.
Yeah. I mean, well, Berkshire's market cap's a trillion.
Okay, that's what I thought. It didn't sound right when I said it. So
Yeah.
the market cap is just under a trillion, so
Yeah.
I think the net asset value is a trillion. I think it's 1.6 is the capitalization. I think what he owns inside the portfolio is 1 billion, and then the capitalization is 1.6. Well, we can revisit again down the road, but I guess it's a huge premium to pay for someone to manage the money. So coming back to my previous point, smart investor puts money in cash. He's got a pretty good track record. Okay. Why could he possibly be doing that? Well, Zach said he's getting for almost 5% in cash at the moment. Okay. The second point I want to make, Goldman Sachs and Vanguard both came out in the last week or two and highlighted the fact that based on their best guesses, based on some of the things we've talked about already, stocks could do 3% after inflation over the next 10 years. Okay. 3% per year over the next 10 years for
Was
large
that real?
cap
That was
US
real.
stocks.
That was
I'm sorry?
real, not nominal. After
Yeah,
inflation.
it was 3%
Okay.
after 1% inflation, they said was their
Okay.
best guess.
Got it. So
And so
basically 4% nominal. Okay.
yep, and Vanguard said 3 to 5 nominal. So this is a big step down. If you remember, the last 10 years have been exceptional. The
Yeah.
last 15 years have been even
And
exceptional. And so I think it's a point. If you're Warren Buffett and you're seeing, gosh, some smart people out there. He's one of those smart people thinking stocks can be underwhelming over the next 10 years. Maybe it makes sense to get quote unquote risk free at 4.5 or 5%. So I just want to highlight that point. And then I saw this too in Barron's 2 weeks ago. What what can we do now? Now that we think, well, maybe if markets are overpriced, and Zach, please chime in here. You know, what are the rich people doing with their money? And this is, of course, data that's a year old, but this is I thought was interesting. Number one, they're moving to private markets. You know, private equity, private real estate, private debt to some extent are seeing a pretty big uptick here. So this is family offices with over $50 million to invest, measuring 2021 versus 2023. And you can see that, you know, public market equities have fallen from, you know, maybe 30-ish% to maybe something slightly less than that. But the bigger winner was fixed income and cash, of course, but then private equity, private companies. So pretty interesting. I think these could be a place to speak with your trusted financial person about reallocating some of these places. And then, Zach, are you familiar with Meb Faber?
Yeah.
It's a name you, yeah. I feel like it's like a, I don't say B-lister because it sounds, but he's like a second tier, also sounds dismissive, but he's a really smart guy, but he's not like at the caliber of Warren Buffett. But there's an awesome interview with him. He manages Cambria Investments, it's got, you know, a gazillion dollars under management, et cetera. But he had this really awesome quote. It was in Barron's last week. And I guess he didn't really put this together. He's saying, you know, they asked him, like, well, what should people be doing with their money? And he said, you know, he said, and I quote, emerging markets are 85% of the global population, 60% of global gross domestic product, but only 10% of market capitalization. And I guess I knew that, but you know, what are your interpretations of that fact, Zach, or that quote?
Well, it's because we've captured all the market capitalization from the labor of the emerging markets. We outsource a lot of the low value add supply chain and manufacturing processes, but it's generally U.S. based and to a lesser extent Europe based companies that capture that market cap. I don't expect that to change. In fact, I kind of expect it to accelerate. That's my
Mm.
personal take on it. So I was saying that the disagreement when I saw this with
Oh,
Mev
this was your
and look
disagreement?
and look,
I
so
thought it was
smart
my
guy.
price to earnings. You came
Look,
at me
smart
hard, buddy, on the price to earnings. I assumed that, but twice in
and
the
look,
same
smart people
podcast.
smart people say this, and I don't want to totally discount because that is the fact, right? That's a factual statement. Um, but I tend to think that we're gonna be going into a situation of declining demographics, and I put a slide in here on China specifically, but it's very similar across much of the especially emerging and developed world. That it's going to be really, really difficult for them to grow their domestic company market caps. I think that we're just going to continue to siphon that off at the expense of their labor. And I don't think that's going to change.
I think that's a great counterpoint. And you know, here, you know, Zach, you're a smart guy. Mid Faber's a really smart person as well. And who knows what the right answer is other than perhaps a diversified portfolio that tries to
Yeah,
cover both bases. So
100%.
I
I
wanted,
don't. Yeah, I don't advocate to like completely jettison your international emerging market exposure. I am underweight it to the benefit of domestic U.S., but not like completely shunning it because it is a large percentage of global GDP, and there are certainly some differentiated types of companies, and so I don't want to like completely get discount it. But yeah, I don't necessarily think because I think we've looked at this chart a few times of the valuation difference, right, between international and domestic markets and how that spread is like the widest it's been, and eventually it's going to turn. Like I don't know if it's going to turn. I really don't.
yeah, you know, it's a great conversation, and it would have been a really terrible idea to, you know, invest against the U.S. large cap markets over the last 3, 5, 10, or 15 years. And so that
Yeah,
actually is a great
because
segue into my next slide,
because
which I
all
think,
that was because all that was the same 5 years ago, right? Like five, six,
yeah.
7 years ago, all those numbers were all the same, and you would have been in a world of hurt if
So
you had made some major allocation decision based on that.
let's dig a little deeper. So that's exactly my next slide. I wanted to highlight here, you know, based on what Meb said, based on our conversation just now. Here I have highlighted four of the major indexes. You know, I have the first on the screen there is the core Europe large cap. Okay, then I have emerging markets. Then I have the iShares small cap IWM, and then just the S&P 500 trust. So the S&P is at the bottom, and I have three highlights here. The 3-year, you can see the 5-year, the 10-year, I have the 15-year as well as the earnings ratio, exactly like we were just talking about. But I want to highlight. I was really surprised with this. Look, over the last 3 years, the S&P has done about 10% per year, but all the three other indexes have been crap. I mean, looking at the Europe has been 1% per year over those 3 years. Emerging markets down 3% per year over those last 3 years, and the small cap about
Yep.
1% per year. It's really surprising to me because everyone talks about the large cap. Of course, that's where a lot of the money is, most of the money is, but in the U.S. at least, the U.S. S&P 500, et cetera. But looking at a five, look at a 10 year, same story. I mean, S&P 13% per year, Russell 8%. Look at emerging markets, less than 3% per year over that time frame.
Brutal.
Just really, really crazy. And then some of the valuations, and Zach, you have a really great point. Like, should there be a valuation? We've talked about kind of the phantom earnings or the negative earnings that get backed out of the Russell. So let's X that number. But then if we look at emerging markets, probably the same. But core Europe, you'd expect there to be similar earning dynamics in that place as well. There's a lot of names that you recognize that we won't mention, but you can think about them. And look at that. I mean, it's at 12.9 price earnings versus 21. Would have been a terrible idea to have this observation 5 years ago and invest in Europe, as we're showing you.
Yep.
I guess the point I'm making here is there's been a wide dispersion here in markets over the last several years. I see you added a slide here, and then I'm going to let you get to that. I've got two more slides here to end on an optimistic note about what's going to happen in the U.S. large cap space. Hopefully, in the next couple of years, this is all hypothetical. But Zach, what did you just pop on there?
So this was just the Berkshire. So I got the numbers for Berkshire. So his total NAV is about 295 billion, cash of 325 billion. So that gets you to, 625, and then market cap of just over a trillion. So I think your multiple was about right. So about 600 billion ish of NAV versus a trillion of market cap.
Berkshire recent price, 694 per share. Your book value per share. Okay, so book value per share, $438,000, and it's trading at 690.
That's essentially the book value, right? That's the market value of their holdings. I mean, you could add in like their offices and things like that to book value. I don't think they have any debt.
So yeah, probably no debt, but how much? Yeah, but yeah, here price to book value 1.6. I guess that's what I was seeing. Market value a billion.
Yeah. Okay. Yep. That makes sense.
All right, let me scoot over here to the next two charts, Zach. Thank you. I'm going to push it back. I want to share two optimistic takes, and pretty usually they come from our friend and former colleague, Ryan Dietrich. I say colleague kind of in a cheeky way. He doesn't know us, but we know him because he's a perma bull, and he takes a lot of
I don't think
guff.
he'd like that.
I know he wouldn't like that. He's usually optimistic.
He has been optimistic.
He has been. I think he does a great job of kind of highlighting
and been
some
totally
things.
correct. And been
And
100%
he's been
spot
right.
on.
And he takes a bunch of flack, like on Twitter, where he posts a lot of stuff, aka X, the X platform. He takes a lot of heat from folks. It's hard to be optimistic. I mean, in the markets. I mean, you sound a lot smarter when you're a bear because it takes some nuanced idea to
Right.
reason out why markets. So he takes a lot of guff, but he's been right. And I just want to highlight two ideas that he posted in last week or so. Markets are at all-time highs, taking a big step back from everything we said. If you pull away one or two notes from everything I said today, and I'm saying a lot because I refuse to close my mouth, but 2 points I want to make here. Number one, there have been 20 times going back in the last 50-ish years that the Federal Reserve has cut rates while the market was near all-time highs, within 2% of all-time highs. And that's what it did 2 weeks ago, right? 2 Thursdays ago.
Mm-hmm.
So there's 20 previous times that's happened. 1 year later, 12 months later, 100% of the time markets were higher with an average of 13.9%. Really intriguing, right? We'll have to see if this is different. Past is not always prologue, but this is a pretty good data set. This is modern markets. This is the market taking the pedal off, putting the, how would you phrase that? Reducing
Cutting
the braking a little
striking.
bit. Yeah, taking his foot off the brake a little bit. And then markets are usually pretty appreciative. So that's the first thing I want to share. And the second thing,
I like that.
I have the optimistic take from a friend, Ryan. This is just a couple of days old. And Zach, this really kind of threw me out of my chair here when I had heard this. So if the markets continue the way they are for the rest of November and into December, it will be the 5th time since 1945 that the markets were up 20% or more 2 years in a row. It doesn't happen very often. It's been a very, very good market. Very, very good.
Yeah.
What happened the previous 4 times?
Wow.
Shockingly, year 3 was up 4 for 4. Not a huge data set. Average return in the third year, 19.99% if you average it out, which is crazy.
Yeah.
There's a lot of momentum.
I probably wouldn't have guessed that.
I follow my churn. It's an expression. It's a turn of phrase, folks. But I was really surprised to see that. And I think you're going to hear a lot of things. We talk about price to earnings and blah, 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 blah. We keep going on with our blahs, but I think that this is a really intriguing point here from our friend Ryan Dietrich, just distilling the information. This is the fifth time. If in fact, famous last words, we've got 5 weeks here left in the year.
Yeah,
Five
yeah.
weeks left in the year, Zach. Are you kidding me? This year's
I
almost
know.
over.
I know. It's
All
amazing.
right. All right, my
That's
friends at
cool.
home.
That,
Thank you
that's
for
good stuff.
bearing with me here. All right, Zach, what do you got for us?
So this is one I slid in there with the Chinese population demographics, and why I just think that the United States, in particular, is just going to continue to command a valuation premium. It's the only country in the developed world that is projected to grow population, not by birth, but by immigration. Um, and most of the other countries in emerging markets and developed that matter for investments are decreasing populations. And in the case of China, is in a population demographic death spiral. Um, it's going to significantly have impacts for their economy, but for geopolitics. It's a topic of a whole book that I recently read called "The End of the World Is Just the Beginning," which is really interesting. It's a very pessimistic book, but
I
but it's
couldn't tell.
but it is an
Couldn't tell by the
interesting book.
title.
It is an interesting book, but population in China has peaked already, and it is expected by the end of the century to be half of what it is today. And there's only two ways to grow your GDP. It's by population growth or productivity growth. And so they're going to have to really, really, really be much more productive. They have not been successful in that. So if you look at the supply chains across the world and where things are produced, you think that kind of if you don't dig into it, you might think that China creates a lot of high value added products, and they don't. They complete a lot of products. They do final assembly for a lot of things, but the high value add semiconductors, the really high value chips, that none of that's done in China. So they have not been successful in going upstream in their value for their supply chains. And I think that now they're staring down this cliff of population decline. And so
I
that's,
think, just to kind of build on that, I
yeah,
don't know if you followed the news in the last week, but there've been 3 week-ish. There've been three like major domestic attacks in China from
I've
frustrated
seen that.
citizens. And if this is floating up to the surface here in Western media, I assume there's more examples of it that we're just not
Not
catching.
hearing about.
But it seems, to your point, there's a lot of internal strife here. And I think there'll be another shoe to drop here in the next 6 to 12 months in China, which, pulling a big step back, we're talking about where do we invest our money at the US capitalization? Well, a lot of people put their money here because we have the rule of law. We have the major tech companies. We have the innovation here. Like that's to your point, it's not happening in China. It's not happening in these emerging markets.
Right.
So, great. God, that's crazy.
And there's many other countries that look like that. Italy, Korea is even worse.
Japan,
France is okay.
Germany.
Germany, this is not a unique situation to China. This is a global problem. The global birth rates are not at replacement level. We're likely to reach peak humanity population sometime in the next couple decades. And it's just been a given that over the last 150 years, a lot of the engine that has driven economic growth and market growth and asset growth has been population growth. We were at 2 billion at the turn of the last century, maybe. We're at like almost 8 now, right? Like that's a 400+%
We take it for granted here even more
take it
so
for
in the US
granted.
because you know, I saw someone making the point like no one's busting down the gates of China to break in, right? No one's
Right.
coming from other, their neighbors geographically. But in America, we have this thing where people are breaking down the doors to try to get in. And like for us, it's a political touch point, of course, but
Yeah.
if it could be considered a blessing because it is, instilling labor into a country because our, what do you call it? Not our
We
domestic, but
will
our like our replacement rate is lower for citizens, and we're only have a growing population because of immigration.
we will all come to appreciate it as a major blessing in the decades to come. And anyone who is economic minded and wants our economy to grow should be very, very, very pro immigration. Now, that doesn't mean it has to be uncontrolled immigration, right? Like, we want to be able to have a system that brings people in that are going to add value to our country. But that is the only way that our economy is going to continue to grow, relative to the rest of the world. And I think that it's just going to continue. I don't think that those valuation gaps are going to close. I think it's going to potentially exacerbate more. So that was the, when I saw that, emerging markets and things like that. That's kind of how I look at it. So next, I want to just do a little bit of an economic postmortem on the election. A couple things that I think kind of led to the result that we saw, and it's the kind of American dream being a little bit out of reach for a lot of people, and they feel that they have not been able to achieve some of these milestones. And this first one of the first-time home buyers share of total U.S. housing purchases reached a low of the last 50 years, 24%. Of first time or of home purchases nationally are first time buyers. And so a lot of young people are, and you saw young people break significantly for Trump, which was not expected. That's typically been a more Democratic cohort, which we talked about in our kind of pre-election show, looking at the demographics. Right, I think one of the slides I put up was, who's Gen Z going to go for? That could really swing it. Well, turned out that they swung much more than expected to Republicans and to Trump. And I think that this was a major reason why, is that they can't afford a home. They can't achieve that major linchpin of the American dream. And the second one's jobs. Now this one is just it's just kind of timing. Like, I don't think the current administration had anything really to do with this. This is just a hangover from the COVID time period, where jobs were very, very, very plentiful. We had quit rates at all-time highs in 22 and 23. You could really, companies were really competing for workers with a lot of wage growth. I think we showed this chart 10 different times, where this U.S. job openings had reached 12 million plus in 22 and had just kind of slowly whittled away. Well, it just so happens that during the year in 2024, we kind of we worked off the complete excess of COVID era excess jobs, and now we're just back kind of to pre-COVID levels, 2019, seven. It's not like we're in a bad position. We still have 7.5 million open jobs, but I think it just feels a lot tighter to folks than it did a couple of years ago, where they were in a situation where they could quit their job and go get another one, and it was no issue, and they were probably going to make more money. And that is not the case anymore, right? It's kind of flipped back a little bit to being in the employers being in a bit more of the driver's seat. You're not getting that situation where workers are able to just walk off the street and get another job, that's kind of what it was in 22, right? I mean, we talked about it several times, where companies were just like desperately trying to find workers, and that's worked off. And so that was the second piece that I think folks within the economy just felt like it wasn't as good as it was, and it was deteriorating. Whether that was one's fault, it doesn't mean anything, right? It's just it is right. That's just the reality of the situation.
So I just you just kind of forget, like, the job market has been so strong for so many years, and just checked, as of last month, as of October, unemployment rate in the U.S. across the country, of course, varies from state to state, is 4.1%. Zach, put you on the spot here. It's for a holiday. We can do that. We're friends. Pop quiz. What is the Federal Reserve's full definition of full employment? If you had to.
4.5.
4.5. I'm just, according to AI, which it says 5 to 5.2 is the current definition. So meaningfully below, right? I mean,
Yeah,
way full
it's not
employment for a
bad.
very long
Yeah.
time.
No, it's not and this next chart will really kind of put the point home that the economists and market participants like us doesn't necessarily translate to like real people, right? Like what we view as being, oh, the labor market's great, right? There's 7.5 million open jobs, 4.1% unemployment rate. That's fantastic. But people view it in a sense of like relativity to what it was 2 years ago, where there were much more open jobs, wages were growing, they could quit and go get another one. To relative to that, it's not as good, right? So we view it on kind of on a relative level, and I think the voting public and folks at large just view it on more of an absolute level. It's just like, or maybe the other way around, right? We view it on kind of an absolute level, they view it on a relative level.
Yeah.
And this next one really,
your grocery bill, your gas prices, those have been, extraordinarily inflationary. And I think that touches those folks, the most
yeah.
voters. And I think that's exactly your point is well taken.
And this next chart here, the Wall Street inflation versus Main Street inflation, I think this, you could look at this and say this was the election. I mean, this was it right here. We in our industry, we look at inflation and saying, oh, hey, it's 2.4%. That's, fantastic. Inflation's gone, right? Main Street doesn't view it that way, right? They view it the absolute level of prices having gone up nonstop since 2020. And they view it with the light blue line, right? I think
Hmm.
and we've talked about this before, the difference between inflation, disinflation, and deflation. And I think folks in the economy at large view inflation coming down as deflation, right? Prices coming down. And we view it as, the rate of inflation coming down, right? Disinflation, less than it was, right? And so, they see all the, CNBC, and they see, market commentators and economic commentators talk about the dark blue line, but in their actual lives, eggs are still as expensive as they have ever been, right? They're not
But
cheaper.
it's impression, right? What is our reality? And you hit it with the first slide. Number one, the American dream is predicated on being able to buy a first house, and it seems more expensive than any point in the last, several decades, right? As a function, as a percentage of your income per year to service the mortgage. And number two, which I don't know if you're going to highlight here, education is just as expensive or more expensive than it's ever been. So those two primary pillars of an American dream,
Yeah.
in our perception for these folks, it's impossible or more impossible, or possible's the wrong word. Difficult is the right word.
Yeah. So that's a little post-mortem on the economic side of things in the election, and kind of looking forward to kind of two main pillars of what the new administration is talking about is the tariff conversation. And this is from Oxford Economics, which does really good analysis of economics. I read them a lot. And they've kind of created this chart here of like the baseline of the trend of tariffs prior to the election of Trump being the dark blue, that our effective tariff rate around 2%, right? It's kind of the same it's been for a long time. And you can see there was a
Hmm.
little uptick in the first Trump administration, but it really wasn't too crazy. I mean, it went up a couple percent, but they were fairly targeted, fairly strategic. It wasn't a major impact of tariffs. The full-blown Trump scenario is what he's talked about on the campaign trail. That's that kind of light gray line. And that would be a major sea change in tariff policy. That's a 60% across the board tariff on China, 25% across the board elsewhere. Their Oxford Economics, new baseline, it thinks it'll fall somewhere much closer to the current baseline rather than the full blown scenario, in the neighborhood of 4-ish% effective tariff
Hmm.
rates. The appointment of
Interesting.
Howard Lutnick as Commerce Secretary, who's very pro tariff, certainly makes that think that they're serious about it. But he's made some really cogent arguments about tariff policy and kind of how they can be implemented. So I think the takeaway from this is that we're not going to see that full blown like what was talked about on the campaign trail. Going back to like the 1930s Smoot-Hawley tariff scenario. Um, but I do think they're going to use them certainly as a bargaining chip, and probably will implement more, especially on China, which another thing just going against the Chinese economy and Chinese markets, because
To
they're kind of
your
in the line
to
of
your
that.
point about the population in China, we talked earlier about emerging markets. I think that's a great point. I mean, maybe this is leverage. We'll have to wait and see. It's so hard to get a read on President Trump, but this could be a leverage factor. I don't think the Chinese economy can afford this type of scenario, and I think it's a bargaining chip. So we'll have to wait and see. Great point.
Yeah, it'll be interesting. But I do think that they're gonna certainly use them. They're gonna use the tariff. Trump said it was the best word in the dictionary, tariff, which is interesting. And then the final piece is looking towards regulation and government spending, and the new DOGE program, the Department of Government
Government
Efficiency,
efficiency.
that more Elon Musk and Vivek Ramaswamy are heading up from outside the government. Not entirely clear how that's going to logistically work, but they've apparently and they've been all over X talking about it. It seems like they're very, very serious about what they're going to do. But you kind of look through the budget and you just see like, well, what could they actually do? Like, where is the spending? And this just kind of lists some categories of government spending and how much it was in 23. If you take out net interest, Social Security, and Medicare, there's not all that much that's left to cut, really. So, I mean, I'm sure they will, certainly reduce regulation. They'll certainly reduce the headcount of government. And that could definitely have knock-on effects to ultimate market productivity, private company productivity, if they don't have to spend as much time and money complying with regulations and interfacing with government agencies. That frees them up to spend capital and time elsewhere, doing what they do for their consumers. But actual like dollars of cutting the federal budget, I don't know how much they'll be able to really do, just because there's not that much that's discretionary. It's like less than a quarter of the federal budget is considered
Well,
discretionary.
it's so interesting. We maybe we'll talk about this more in future podcasts. But there was a op-ed in the Journal last week talking about this very topic, right? And highlighted one point. What's the number that Elon Musk has thrown around and is often
Two
quoted?
trillion, impossible.
Two
It's really
trillion.
like impossible.
But the point they made was he never said if it was annual or over like a 10-year. Like, isn't that
Yeah,
something
true.
that they tend to do? Is
Yep.
like it's going to be $2 trillion over the next X number of years. So that's a
Yep.
possibility. But secondly, they also highlighted like how could you do it well? If you make, the third rail has always been Medicare and Social Security. If you make some adjustments to that, whether it's pushing Medicare to more align with Social Security in terms of the time you can claim it, maybe there's some changes that could be made on that third rail that if you touch it, you end your
Yeah.
political career. Elon Musk doesn't care about that stuff, so we'll have to wait and see. I mean, I'm glad we're having that conversation. It is unsustainable. It's something we've talked
Yes.
about many times in this podcast. So I'm stoked that people are even talking about it.
Yeah. And it's just been, an inertia of growth. The federal government has just grown by pure inertia over decades, and it's very big and bloated. So we'll see. Maybe they'll be able to kind of make things more efficient and run better. So I'm going to be cautiously optimistic on it. And finally, a little bit of positivity here.
I
Holidays and
like it. You took
happy
a cue out of my, like, we're all
happy
finishing on a
investors. Make sure
positive
make
note
sure the
here.
last slide's just something happy. And the best 6 months of the year are here, November to April,
Yay. Woohoo.
77% higher, going back to 1950, average percent change
Hey, where did you
7%.
pull this fact set from?
Oh, this is our buddy.
Our good friend, our
We,
pal.
we
You
really
gotta
we
have
should
him on
probably
sometime.
we should have him on, or we should pay him for his charts because he's generating a lot of content for our podcast here. But
Man,
yeah, we're going into that period, right? It's holidays, and it's usually majority of the time a good time for markets.
typically it is. And I think that's a great point to end it. I think there's plenty of reasons to be optimistic, right? The market has a lot of momentum, and we'll have to wait and see how things plan out. We'll continue to address these questions and others on Finance Footnotes. And folks, if you have questions, please don't forget to send them in. We always appreciate the
And
thousands of comments we're getting.
have a wonderful Thanksgiving with your families and not talk politics at the dinner
Yeah,
table.
avoid politics. Avoid fist fights, for crying out loud, folks. We're all family and friends here. We'll touch base with you, folks. We'll see you in December. We'll touch base regarding the year-end planning. And until then, see you next time on Finance Footnotes.